Afternoon, everybody. Doing Shabba there from DRFX Sport Swing Trading. Today I'm going to take a look at the situation on the Kiwi Japanese yen pair. I'm going to take a look at what has been the most recent currency patterns on this pair and identify if there are any trading opportunities that might present themselves over the next few days heading into the following week. Now, let's take a look at what the situation is first of all on the daily chart. Narrowing the candles like this, we can appreciate that the pair has actually been in a very strong uptrend since 2008, starting with this very low support area and extending the line to the next low point. We can see that this would be the outer uptrend line, and that continuing from this support point, drawing another line, we can see here that another trend line, referred to as the inner uptrend line, was also formed. So this uptrend, which has been in place for the last 7 years, was basically defined by these two uptrend lines, outer uptrend line and the inner uptrend line. Now, taking a closer look, we can see here that the market appears to have been moving in a very has taken on a very sideways pattern since early 2014. So basically, for over the last 12 months, this pair has actually been moving in a very indecisive pattern, moving sideways. And if we were to look at the pattern here that is taking place, we can see something very familiar. This section here was followed by a rally and then a U-turn, followed by a brief rally and the formation of another pattern just above this inner uptrend line. Now, if we were to identify what these patterns are, drawing the relative lines of support and resistance here, we can see that this was actually a pennant that was broken bullish, followed by a sharp U-turn. And then this rally and movement that has taken place in the last several days is actually another smaller pennant consolidation formation. So essentially what we have here is something that is very familiar when the market has essentially reached when the market looks as if it's coming, the trend that has been in place for a very long time is about to end. What we see here is essentially a bear crown or head and shoulders pattern, with this pennant over here representing the left tip of that formation, and the rally that took place after the breakout from this pennant is essentially would be the center tip or the head of that head and shoulders pattern, and the right tip or the right shoulder will be represented by this pennant formation just above the inner uptrend line. So what this is shaping up to be is the start of a major downtrend, major trend change that will take us below this inner uptrend line to start a significant downtrend in favor of the Japanese yen over the medium to long term. And if this materializes, then we're likely to see a movement down to the 73.24 area, which probably will take us into closer to 2016, the middle of 2016. So this is something. This pattern is something that I've spoken about before, and it's something that you would have come across in the market on several occasions with several currency pairs. On the Aussie Canadian dollar, for example, this is just to show that this is a typical example of what you would expect on a bear crown setup. This took place on the Aussie Canada pair in, what was this? This was last year, 2014. And on the Euro Canadian dollar, we see here that the the strong downtrend that has been in place since last year as well, 2014, was also the result of the formation of a bear crown head and shoulders pattern. So this is something that you will see across several currency pairs whenever the market is about to change direction significantly. Then you're going to see these types of patterns that indicate that the trend direction will change, and for at least the next year or two. Zooming in, we can see that this was in fact the situation on the Euro Canadian dollar, with the left tip being formed on this side. Let's draw this trend line here. You can see here that in forming this formation, we also had a break of this uptrend line as well, this inner uptrend line. Actually, there's another one. So what you'll find is that whenever trends are changing, you see the candlestick patterns such as head and shoulders, bear crowns, double bottoms, as well as consolidation, double tops, double bottoms, as well as consolidation breakouts. And usually those candlestick patterns are associated with or followed by breaks of trend lines as well that had defined the previous or existing trend. So here we see that the trend change, the crown setup was formed with this counter trend line break, followed by a U-turn to form the head or the center tip, and a break of these two uptrend lines, followed by the formation of a pennant that would form the right tip or the right shoulder of the pattern. So after this, the following step after this was these three components were formed. The support of this pennant was eventually broken with a strong bear candle, to then lead to the breakout and the subsequent breaks of these outer uptrend lines, and the start and completion of this downtrend that we see today. So what this means for the key Japanese yen is that given one, that we have a strong bearish pattern, a bear crown head and shoulders pattern, and two, that it is a very significant pattern, a very large pattern. We have a very strong chance that this pennant will be broken bearish to start a new downtrend. Now, with respect to consolidation boundaries in general, such as these, analyzing them by themselves, they have a 50-50 chance of breaking out in either direction. However, as with all patterns, we have to look at them within the context of the wider market trend, wider market pattern. Given this formation, the probability that we'll actually have a bearish breakout and that it will lead to a strong bearish trend is much more significant than if we were to look at this pattern alone by itself. So essentially, what we are likely to see in the next couple of days is a breakout below this support, as well as this inner uptrend line. Right? So once we see something that presents itself in terms of a trading opportunity using the trade sheet that we have, and as long as the patterns and signals that we see on the daily and the 4-hour chart conform to those elements that we use on the trade sheet, then a trade is possible as the market begins to break out in this direction. So let's see what happens in the next couple of days, and hopefully a trading opportunity presents itself from which we can capture another 200 pips from this expected sharp breakout pattern for this pair.